Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about the best alternatives to term deposits. Now, obviously term deposit rates have been falling over the years and they're currently ranging anywhere between 1 and 2%. So they're barely keeping up with inflation, and if the RBA cuts rates as they are expected to this year, either one or two more times, rates are going to fall even further. And if the majority of economists and commentators are correct in that we'll be in a very low to no interest rate or zero interest rate environment for a longer period of time, then at some point, more and more investors are going to start considering what else do they do with their cash other than invest in term deposits. But I find in the conversations that I've been having over the last year or so in respect to this, that there's one massive mistake that people make, and that's what I'd like to talk about. Now, even if you don't have term deposit investments, say if you're in your 30s or 40s, you're probably not really investing a lot of money in term deposits, rightly so. It's something to keep your eye out, particularly if you've got parents that are in retirement and they've got cash. More likely than not, they've got their monies in term deposits. So something you might be able to help them with, at least steering them in the right direction. So what's the number one mistake? Well, in my opinion, you cannot talk about returns without also talking about risk. You've almost got to speak about the two things in the same breath. And legendary investor Ben Graham, who's really regarded as the father of value investing and taught Warren Buffett at university, said, and I quote, "The essence of investment management is the management of risk, not the management of returns." So that's really a very important quote, I think, from possibly one of the best investors ever to live on the face of the earth, that it's all about risk management rather than returns management. And I think this highlights the number one mistake is that people, and particularly retirees, focus almost only on returns without any regard to risk. And quite often when people think about term deposits, it's very tempting for them to start thinking, well, maybe I should just invest in shares. As I talked about in my podcast last week, or I used the example, Westpac at the moment, its grossed up yield, dividend yield, is 10%. And when you compare 10% income from dividends in Westpac shares to term deposit rates, it looks relatively tempting. But think about it, term deposits are almost a risk-free investment, particularly if you've got 250 with a ADI, approved deposit institution, a bank, as they're guaranteed by the government. So really it's a risk-free investment. However, shares have a lot of volatility, and volatility in my view is tantamount to risk, because volatility really describes how likely will the return be, the projected return meet your expectations. And shares have a volatility rate of 18 to 25%, which means that the standard deviation of the returns is 18 to 25%. So if the expected return is 10%, your actual return on any 1 year can be anywhere in the range of negative 15 to positive 35. And that's a big range. And that, to me, feels like a risky asset, certainly in the short term. Notwithstanding that, the market could crash as well. So we could go, let's go invest in Westpac shares. Either Westpac has some massive problems, or more massive problems, I should say, or the market crashes and you lose a lot of your capital. So the common mistake is to avoid or not give consideration to risk. And so, for example, if you had a retiree that had, say, 35% of their money's in safe assets, in term deposits, and let's say 65% in risky assets, so shares, if they then turn around and say, look, of that 35%, it's not really generating any more money, let's put it into shares because at least I'm going to get 10% versus 2% in term deposits, I'm actually better off. Well, now you've got all your money invested in more risky assets, and that's not necessarily a prudent thing to do, particularly for someone in retirement. At some point, capital preservation becomes more important than investment returns, and that is that avoiding losing money is justifiably more important than making money, and that would be true, again, particularly for people that are in or closer to retirement. And Telstra is a really good example. Historically, investors have been attracted to investing in Telstra primarily for its high dividend yield. And it's been touted as, for self-managed super funds in particular, what a great stock. Here it is. And over the past 10 years, the grossed up dividend yield has been somewhere between 5 and 10%. And for most of the time, around about the midpoint, 7.5%. So it's been a good income generating share. However, a good example is spare for people that invested in Telstra in 2015 when they were trading at close to or above $6. The investor that did that has lost 35% of its value, of their value of capital value, and may never recover that amount again. In fact, I would say it's highly unlikely they will. So sometimes chasing returns, or not sometimes, I should say all the time chasing returns without any consideration of risk is a recipe for disaster. There's a big chance that all we're going to do is just make mistakes. Okay, so let's then think about what are the alternatives to investing in term deposits if what we're chasing is firstly an income style asset that has low capital risk. If that's the brief, for example, which is typically the brief that drove people to invest in term deposits, what are the alternatives? Well, I've got 5 for you, but before I jump into that, a few things just to clarify. Firstly, I'm going to talk about them in order of risk, so low risk to high risk. Secondly, it's likely that the best solution for you is a combination of some or all of these alternatives rather than necessarily picking one. Thirdly, it's not an exhaustive list. There may be other alternative investments that might suit your situation even better. These are merely just examples. And lastly, please don't act upon this advice or information in this podcast alone. It's important that you get some independent, personalised advice to make sure that what you're doing is appropriate. Okay, so let's get into it. 5 options. The first one is investment-grade corporate bonds. So with central banks cutting official interest rates around the world, government and treasury bonds are really providing very low yields. Government yields in Australia are just over 1%, and frankly, you're probably better off investing in a term deposit than a government or treasury bond at this stage. And as I said, interest rate expectations for the future aren't that optimistic, so it doesn't look like that's going to change anytime soon. Therefore, we have to look to the corporate sector in order to generate a higher income. And investment-grade corporate bonds are relatively low-risk investments, especially for an investor that holds them through to maturity. You buy a bond at issue with a face value of $100, and if you hold it through to maturity, you'll get your $100 back. So really no change in capital, and you'll pick up the coupon, which is really the interest rate, along the way, for the term of the bond. A bond is a very simple investment. It's more like a loan to the market. So a very low risk listed entity, be it, let's say Telstra, for example, will sell a bond to the market. It's a way of them raising debt. And they might sell a bond for $100 and agree to pay you back that $100 in 5 years' time, and between now and then pay you a coupon of, say, 5%, for example. There haven't been any investment-grade rated bond defaults in Australia, at least in the last 30 plus years. So it's very unlikely that, or at least your capital is relatively stable. But more important, there are a few different index fund providers, such as Russell, BetaShares, and Vanguard, are probably the 3 that are most common, or I most commonly use. And they're yielding in the range of 3.5% to 4% in terms of income. And as I said, their capital is relatively stable. The income of 3.5% to 4% is indirectly linked to the RBA cash rate. So if the RBA reduces rates, those rates will come down as well. In terms of picking the right index bond fund, Australian Corporate Bond Index Fund, there's a couple of things to watch out for. The first one is concentration risk. So you need to look at their indexing methodology, and you don't want to have too many bonds in one particular issuer. And depending on the methodology, that can sometimes be an issue. Excuse the pun. And secondly, you need to understand whether the bonds are fixed or floating, coupons, and the duration within the portfolio, which is a term I've got a link to explain that better. Because that will have an impact on the capital price. So some bond funds will have a really strong negative correlation with equities, and others will have less so. So it's really important that you understand what you're investing in and how it's going to behave in different market conditions. So that's the first one, investment grade corporate bonds, 3.5% to 4%. The next one is hybrid securities, and you're going to get around about 4% of income there. Hybrid securities are typically issued by the Australian banks, and they're essentially a cross between an equity and a bond. So it might have the features of a bond at the beginning, and with the ability for the issuer to convert that bond into shares if they want, rather than repay the bond. Each security will have its own unique terms and conditions, and really, as such, no two hybrid securities are the same. And so they can vary in terms of risk and return. So you really need to be an expert in that area. And so to accommodate these risks, I typically prefer to use active investment management when investing in hybrid securities, as opposed to indexing, which I usually advocate. And the reason for that is that, securities need to be assessed and valued individually to work out whether if they're worth investing in. That is, are you adequately rewarded for the risk that you're taking? Historically, hybrid securities have 1/3 of the volatility of shares, so much like bonds. So their capital value is relatively stable, and you'll pick up that coupon rate. I've got a link in the show notes to the fund that I am quite fond of that BetaShares run. The third is global infrastructure. Infrastructure involves in investing in businesses that own or operate, high-cost assets such as toll roads, communication assets, electrical systems, and so forth. And these investments usually generate a predictable and stable income, particularly in a low interest rate environment. And I say a low interest rate environment because these infrastructure vehicles tend to hold a reasonable portion of debt because they're investing in high-cost assets. And I believe that infrastructure will attract quite a bit of investment over the next period of time, particularly if economies are worried about a global slowdown, because given governments have exhausted a lot of monetary policy initiatives such as cutting interest rates and quantitative easing and these sorts of things, in order to stimulate the economy from here, we're going to need governments to start to spend. That is, loosen fiscal policy, which usually means spending on infrastructure. And Australia's, in the last few months, is a good example of that. Infrastructure investments have historically paid a stable income around about 3.5%, with relatively low volatility. And returns in infrastructure indexes have been over 13% in the last 10 years. So there's a chance there you'll pick up some growth as well as the income. The things to look out for is level of diversification, both in terms of sector and geography. And then secondly, currency hedging, because if you want diversification with geography, you're going to have to invest in international infrastructure assets. Again, you can do this through index funds. Again, you need to be concerned about the diversification and currency hedging regimes of those funds. The fourth option is global real estate, which is really investing in real estate investment trusts and companies, or the term is REITs as the acronym. And they're really listed entities that generate most or all of their profit from rental income. So really holding commercial assets and renting them to tenants. And as I said, they tend to be listed companies in developed markets. Because these sorts of companies, again, hold reasonable large amounts of debt, in a low or zero interest rate environment, they tend to perform even better, and particularly in terms of income, but also capital value. I tend to avoid Australian REITs because they typically have too much retail property, particularly on a look-through basis. When you really pull them apart, they might have close to 50% of retail, and that's not, we all know what's happening in the retail sector, and we probably don't want too much exposure to that. International REITs have historically paid a stable income around about 4%, again with relatively low volatility. 10-year returns of income plus growth have been over 12% over the last 10 years, so again, tend to pick up a bit of growth there. And the things to look out for are very similar to infrastructure, so same diversification and currency hedging. So that's a fourth option, global real estate. The fifth is high-yielding shares. Now, I know that I said at the beginning of this that high-yielding shares aren't necessarily a good proxy for term deposits, particularly because they have high volatility. And that is true. One way to mitigate some of that risk is to use a high-yielding index fund rather than just picking shares like a Telstra and so forth, or a Westpac. And there are a couple of different index providers, Vanguard, BetaShares and iShares, that have high-yielding Australian share products that will typically hold anywhere from 20 to 60 companies, and they'll generate a grossed-up dividend yield of 5 to 10%, depending on the product and so forth. Again, I'd be very cautious about putting a lot of money in something like that, particularly if you're heavily or deep into retirement, because again, you're taking money out of a low risk or no risk asset and putting it into a high risk asset. So they're the 5 options. I'll just go through them again. Investment grade bonds, 3.5% to 4%. Hybrid securities, 4%. Global infrastructure, 3.5%. Global real estate, 4%. And high-yielding shares, 5 to 10%. The final thing or thought I will leave you with is be careful about chasing income or building an asset allocation purely around chasing income, because it can result in a higher risk approach. Instead, the better thing to do is target a combination of capital and income returns. And over time, you might start eating into some savings because your portfolio's not generating enough income alone, but sometimes that can still be a better approach. And I've got a link to a blog that I wrote a few years ago in respect to that to sort of expand on that point. Okay, so to sum up, in a low or even zero interest rate environment, more and more people are going to move away from term deposits, I think. And understandably so. There's lots of different good alternatives. Probably a combination of some of the things that I've spoken about will likely be the best approach. Of course, you cannot talk about returns without also talking about risk. You need to consider those two things together, and that's probably the number one thing that I want to leave with you. And remember what Ben Graham said. The essence of investment management is management of risk, not management of returns. Of course, if you need help, don't hesitate to reach out to us. And until next week, bye for now.